Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks follow Wall Street lower as investors turn risk-averse over Trump's tariffs flip-flops. Bitcoin falls as details of a U.S. strategic reserve underwhelmed. ARK Invest will be joining us for insights as the tech-heavy Nasdaq index hit correction. We will ask if it will get back into Chinese tech shares. And as China's government looks to boost consumption, we get a view from the CEO of the country's largest online travel platform. Trip.com's Jane Sun will be joining us ahead on the show. Our top story today, President Donald Trump is delaying his 25% tariffs on some Mexican and Canadian goods covered by the North American Trade Agreement known as USMCA. That includes items such as automobiles and certain fertilizers. The duties are now expected to take effect on April 2nd, when Trump is also expected to unveil plans for global reciprocal duties.
Most of the tariffs go in April the 2nd. Right now we have some temporary ones and small ones on relatively small, although it's a lot of money, having to do with Mexico and Canada. But the predominant tariffs will go, they'll be reciprocal in nature.
Well, the back and forth in Trump's trade policy is unnerving investors. China's January-February exports in USD terms rising 2.3%. Estimates were for 5.9%, so in positive territory. But we've seen exports, of course, declining. Solid, but still declining. China January-February imports in USD terms falling 8.4%. The estimate was for an increase of 1%. So in balance, a positive for exports. Remember that China has seen a trade surplus on the back of exporting more than it imports. We're seeing that trend, and exports has been one of the bright spots where we're seeing, in fact, an easing in terms of export numbers as well. In terms of USD terms, imports in January to February, and in terms of trade surplus is coming in at $170 billion. The estimate was $147.5 billion. So those are the export numbers out of China, and easing in terms of export numbers. Well, amid Washington's flip-flop on tariffs, Bank of America CEO Brian Moynihan says he remains optimistic about the overall business environment. He talked to us exclusively about how they're navigating the impact of President Trump's policies.
Well, I think clearly on the business side, you after the election, you had businesses very enthusiastic about the lower regulatory burden they'd have, the ability to get deals done. And you went from conversations last summer, which were sort of interesting conversations with the boards. Our teammates tell me they go in and they talk and they'd show them these deals and they'd say that makes sense, but it may be hard to get it done now, to, get in here and let's talk about these deals. President Trump's administration has made it clear they're trying to get some things done, which may cause some short-term, sort of lack of understanding. That affects the business community, but they're saying in the end of the day, and the President said in a speech the other day, we may have some short-term disruption to get to the long-term goal of downsizing government, downsizing regulation, et cetera. And I think the businesses now are sort of saying, well, I've got to figure that answer out. And that's fine, because it's what it feels like forever, a month or two or three. But meanwhile, on the consumer side, you're not seeing any change in activity, despite what they're saying, which is interesting.
Tell us a little bit about that, because in your last earnings call in January, and that was before the inauguration of President Trump, you were saying that consumers were still spending more than last year. Is that still the case? So if this is sort of the dichotomy of what a consumer says they're thinking about versus what they actually do. So if you read the information of the last month or so, consumer confidence has come down and they're worried about inflation going up and all that. That's sort of what they say they're going to do. What they really are doing, in the month of February, they spent 6% more money out of our accounts into the economy than they did last February. And year to date, it's about 6.5%. You compare that to the fourth quarter, it was about 4.5%. We felt pretty good about that. So the consumer is still spending. And by the way, if you look at what they spent on food, basically flat in February. So despite the discussion about egg prices and things, the actual total expenditure is about flat. Services, travel, entertainment,
growing, and that helps drive jobs, because all spending by consumers drives jobs, but the ones that are service-oriented and the entertainment require a lot of people to service them.
Aren't other policies from the administration, though, a little bit more disruptive when it comes to, say, immigration and hiring for these small and medium-sized businesses?
Well, if you go to small and medium-sized businesses, they've been facing two issues. One is the real cost of money went up a lot for them because they borrow on lines of credit, short-term lines of credit, and so they have to make sure, when you're talking about you have SOFR at 4.5% or whatever plus their spread. That was SOFR at 50 basis points plus their spread. That was a big change in rates. So they had to always be more careful. When you saw them kind of conservatively handle their lines of credit usage and stuff, then the election happens and they feel really good about the regulatory. But they started noticing they weren't be able to hire as easily and stuff. And so they're worried about, where people think they're worried about inflation, they're actually right now a little bit more worried about getting employees and running the businesses. And I think as these policies settle in, you'll see them settle in. But they were over-regulated. All companies were, but the small, medium-sized businesses felt all the labor regulation stuff. We have thousands of people who can deal with it. They don't. And so if you're running your own business, and they feel good about that, but it's offset by, let's get a set of rules set and then we can go.
Bank of America Chairman and CEO Brian Moynihan speaking exclusively with the Asia Trade co-anchor Sherry Yon. Now, just 2 weeks ago, high-flying mega tech stocks and their chip-making cousins were powering the Nasdaq 100 index to yet another record. But the feast now appears to be over. The index tumbled 2.8% on Thursday. Let's get to Tasha Keeney, Director of Investment Analysis at ARK Invest. ARK manages several actively managed exchange-traded funds and invests extensively in tech stocks. Tasha, good to have you with us. Not too long ago, we were talking about how, the Mag 7s, they're invincible, but of late, maybe, the story no longer stands. What's your take?
Well, at ARK, we're long-term investors. We look out over the 5 to 10-year time horizon here. So I'd say broadly, we're still very bullish on innovation. There's been a lot of talks of the new administration, of course, for technologies that we look at, for instance, autonomous vehicles. If the regulatory path is streamlined for robo-taxis, which we think could be largely beneficial, they'll save lives. We think, the market opportunity is measured in the trillions. That would be a good thing. So I'd say that, long term, our focus is still there. Short term, I think there could be some uneasiness, but overall, we think that, we're still very bullish on innovation broadly, on all the tailwinds that we've been seeing from AI over the past year. So I'm excited about it.
Is it uneasiness or is it panic? I mean, we have NVIDIA slumping 20% in 2 weeks.
Yeah, I think there's a lot of uncertainty right now, right? And we'll likely get a lot of answers as there's sort of more clarity on, we saw today there's some back and forth on tariffs. We haven't quite gotten the end state yet, and we'll likely get those answers, and that'll, I think, lead to some settlement here. But again, I think broadly we're excited about innovation. I mentioned robo-taxis could be a multi-trillion-dollar opportunity here. We've seen drastic improvements in AI. Autonomous logistics, another area that I look at. This is really the year for autonomous transportation. I mean, in the U.S. here, we're going to see driverless trucks hitting the roads very shortly, any day now. Drones as well, delivering packages for, a fraction of the cost of today's transportation effort. So, innovation broadly can lead to positive deflation. So I think, letting that innovation, again, easing the path to letting that innovation come to its full fruition is a good thing.
Well, Tasha, long-term investors have to look at near-term developments as well, because that may dictate what happens in the long run. When you take a look at the AI space, the big tech space that you're in right now, is China, in fact, upending that AI trade? How much of this has to do with developments in China, in AI?
Yeah, this is a market that we're closely watching. Of course, we're seeing the economy turn around there. It's interesting to see the developments that we're seeing out of, the DeepSeek R1 model, for instance. We still see, U.S. large language models on a performance basis depending on what benchmark you look at, surpassing their Chinese competitors. But I'd say that broadly the story is that, AI training costs are coming down. This should be beneficial for the whole industry. It'll certainly be beneficial for areas like robotics and embodied AI. So I think that, that's something that you can say broadly that, despite sort of these fears of Chinese competition, like globally, where are we headed here? AI is going to boost productivity, and that's overall good for the economy. And, we still see the U.S. as a leader in many of these areas.
So given the optimism that you hold, would the sell-off be a buying opportunity for you? Would you be picking up more NVIDIA shares, for instance?
Well, I can't say specifically about any future trades that we would make. But, I will say that, again, we look broadly at innovation. I actually particularly focus on the robotics space here. So as NVIDIA pertains to robotics companies, it powers autonomous cars. Companies like Tesla have decided to make their own chips in-house. But NVIDIA is still, the top choice for many players that are unable to make their own inference chips. And so I think that, relationship will likely hold for the near-term future here. For, again, one of the largest markets that we see in AI.
We're obviously looking at a repricing in the growth stocks like NVIDIA and so on and so forth. I'm just wondering, how are you looking at this, how this might play out?
Yeah, so, in general, we use certain price swings as opportunities in our portfolios. I think that we look, I can't say anything about what we would do about immediate trading activity here. But I will say that we are, bullish on this is the year for innovation. It's the year for robotaxis, as I mentioned. We have companies like Tesla that plan on launching these platforms. Tesla plans on launching in June. So I think these are a lot of important catalysts that we have to look forward to later in the year. So I look forward to those.
Okay, let's take a look at the themes and the kind of stocks that you're looking into. You talk about innovation, you talk about robotaxis. We're looking at those in the Chinese market as well. There are big players there, and it does seem like optimism is returning in the market that this is the place to be. Would you perhaps relook at some of these stocks in China? I mean, at one time you were a buyer, ARK Invest was a buyer of Chinese stocks.
Yes, we do still own some Chinese names. BYD is one of them, for instance, in the electric vehicle space. But I'd say broadly, we're monitoring this activity. If you look at, for instance, the auto market, and as I mentioned, robotaxi is what we think will be one of the biggest opportunities here. Price competition in China is fierce, and I think it'll continue to remain so. I mean, the price of ride-hail on a U.S. equivalent basis is roughly 30 cents per mile. In the U.S., you have a nice price ceiling of around $2.50 per mile for technology companies to launch driverless cars. So that's a tough market to come into, no matter what player you are, even if you have amazing technology. So I do still think we'll see some of those. We're taking a case-by-case look at the different technologies that are covers to find those opportunities. But again, it's something that we're closely watching. I mean, these are real competitors here. Obviously, China's a very important market, and we'll have to see.
Are you concerned about risk from the regulatory landscape? Perhaps Trump could clamp down on U.S. companies holding stocks in Chinese companies?
Again, on policy, we'll have to see where it plays out. I think, our founder, Cathie Wood, I think she'd say that Trump, he is ultimately going to be judged by the economy. That's the benchmark that he will be measured on. So she thinks that he'll be, careful in terms of which policies he rolls out, and in terms of thinking about that. So, right now we're seeing a fair amount of negotiation happening on the back end of these deals and announcements that we're seeing. It's still, again, in flux, as we saw from today's tariff announcements. So we'll have to see. But again, we're looking at it as a real market in terms of certain technology leaders. Price competition very fierce there. It's always going to be. We'll have to see how the policies play out.
We've been talking about robo-taxi, and that's a big idea for 2025 for ARK. I'm just wondering how best to play this. I mean, Tesla, obviously a big player in it, but, lots of questions about whether it will do it alone and whether it can do it alone.
Well, I think that's that's actually Tesla's special sauce. Really, is their vertical integration strategy. The fact that they're a vertically integrated auto manufacturer here, they're developing the technology in-house, they're building compute in-house, they're building the humanoid robots of the future. That's a real competitive advantage, because if you look at other players, say if you're not an automaker and you have to partner, getting to scale is a different equation for you, right? Because then you're buying vehicles at cost to put on the road. You're having to negotiate relationships with automakers in order to do so. So we think that the software companies, the technology companies here will be the winners. And Tesla's a clear leader. I mean, they already have scale because they have customer cars on the road that are collecting data. If you look at the number of miles of data that we think that Tesla has access to versus a player like Waymo, which is Alphabet's effort, that's roughly 100,000 miles, say, per day versus 10 million. So it's an order of magnitude difference there. So I think that data advantage is really critical for Tesla. So that's what we think will give them a lead in this space.
So one analyst did say that in order for Tesla to be a real player in the space, it has to transport about 100,000 customers in a week. And so far, it hasn't come close to that, or else it becomes just a fiction. How soon do you think Tesla will get to that?
Well, I think a few things. The measure of progress, we're looking for the June launch of the robotaxi network. That's what Tesla's promised here. I think that, we know that they've been testing the service in California, and they plan to launch in Texas. They could launch in both states by the end of the year, potentially. So, what does initial successful launch look like? Well, Tesla actually has a different strategy than others because they don't have a geo-fenced solution. So when Waymo goes to a new city, they have to, unleash cars on the road, gather data from that experience, and then become comfortable enough to really start the commercial service. For Tesla, it's different because they get information and data from customer cars on a daily basis that travel all over the U.S. and really all over the world, which could set them up for, potential future international launches here. So I think that success will look like them launching as promised in June, and they could actually be one of the first players to scale because they have millions of cars on the road. They could potentially pull from those as customers may choose to sign their vehicles up for the fleet, or they could pull from production vehicles and sort of make that choice depending on consumer demand at that point in time. So the point is, they have access to and will have access to really vehicles that number in the millions versus their peers, which at most have vehicles in the thousands, really. The last reported number that we got from Waymo is less than 1,000 cars. Perhaps they have more now, but that just gives you an idea of the scale that Tesla has versus others. So once they lower the cost per mile to below that of human ride hail, I think that's when the service really takes off. So I'm excited for that future, and I think that Tesla could be the first company to do this at scale.
Right. You're invested in Tesla. You're also invested in BYD. How do you compare the two?
Yes, well, BYD is, of course, a leader in electric vehicles broadly. Electric vehicles are taking share and will continue to take share from gas combustion cars because we believe that they're writing down a rights law, which says that for every cumulative doubling in production, you get a corresponding reduction in price. They have a more attractive cost decline curve than gas-powered cars. It's a newer technology. So despite the recent pullback that we've seen in the market, longer term, that's the real story with EVs. And of course, BYD is a leader in China. Versus Tesla, they don't have the software edge. For instance, they're launching assisted driving features on their vehicles. They're not launching robo-taxi services. That's where I think the real market opportunity is here. The autonomous ride-hail opportunity is what I think will be measured in the trillions versus these add-on services that you sell with consumer cars. So I think that they're very well positioned in the electric space. The future of the auto industry is really autonomy plus electrification.
Right.
So that's what Tesla has.
Tasha, before we let you go, just your thoughts on cryptocurrencies, Bitcoin in particular. I mean, we saw gyrations today on the back of, the U.S. saying it's not buying more Bitcoin for its reserves. I'm just wondering, I mean, there's that assumption made by ARK Invest that Bitcoin will get to $1.5 million by 2030. I mean, what is the leading assumption for that to happen?
Yes, well, first I'd encourage everyone to go look at our Big Ideas report, and we have a whole section on Bitcoin there with some great research from my colleagues that I likely will not do justice. But, overall, we're seeing a lot of positive developments here. Like today we saw, the U.S., the new administration announced the Bitcoin reserve. They're keeping some of the confiscated Bitcoin that the government already had. But the announcement is that they have no plans to sell this Bitcoin.
Right.
So in our research, we've done a lot of work to show that we think that Bitcoin really has staying power here and is a stable form of monetary policy. We again, in the report, we have some examples where if you look at, the growth rate in the supply of Bitcoin compared to gold, it's actually slowed versus the long-term rate of gold. So again, that to us suggests staying power. So excited about these announcements.
Tasha, thank you so much for joining us. Tasha Keeney, Director of Investment Analysis at ARK Invest. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Just to recap some of the trade data out of China. In the January-February period, exports in USD terms rose 2.3%. The estimate was for 5.9%. Essentially, we're seeing trade increase, but at a slower level. Remember that trade has been among its, in fact, exports have been among its few bright spots of the country. In terms of imports, January, February, in USD terms, falling 8.4%. The estimate was for a rise of 1%. Imports, again, disappointing in a big way. And in terms of that trade surplus, coming in at $170.5 billion, the estimate was for $147.5 billion. China, of course, has a trade surplus. That's been the bugbear for the U.S., of course. It's been exporting more than it imports, and this is one issue that President Trump would like to address. Now, speaking of trade and China, Bloomberg's China correspondent Min Min Lo will be joining us from Beijing right now. Min, the reaction on the ground on trade.
Yeah, obviously it's a big miss on both export and import number, and that is from the first 2 months of the year, despite that Lunar New Year holiday, which was supposed to be a big shopping season. And clearly exporters and importers are putting things on hold amid these trade tariffs that are being imposed and the uncertainties going forward and how exactly China was going to retaliate. And especially that imports number, particularly disappointing. It was supposed to rise by 1%. It was down by about 8.4%, which shows the weakness in that domestic demand and how important it is for China to really double down on their efforts to boost domestic demand here. And I have the perfect guest here to talk about that, because we have Juliana Cheng, who is the Executive Director of Parkson Retail, a department store, a foreign-owned department store in China. Juliana, thank you for joining us in the Beijing studio. So you have been operating these stores in China for 30 over years, and you were here throughout the go-go years in the early 2000s, the 2010s, where you were expanding by 6 to 8 stores per year on average. But of course, now it's a very different story. Tell us your outlook for this year.
Well, the traditional retail industry faced disruption from the rise of e-commerce for over a decade. And the trend accelerated with the onset of COVID. But having said that, the government did put in measures and also will have further measures to boost consumptions.
And I noticed that when I looked at your financial data, actually you have been making losses since 2017, but you had a good year in 2023, 66 million yuan in profits, but then it was back to about 170 million yuan losses last year. So this contraction has been going on for some time. How long do you think you could get to a profitable space again?
You know, for Parkson, we are always actively transforming, and at the same time, we are adjusting our business model, and we are confident in the consumer trend, consumer positive consumption trend, and also in the first place, we are still expanding in China. So China has population of 1.4 billion. That is a huge consumption potential for us. And also our chairman, Tan Sri William Cheng, he has always advocated the expansion of Parkson in China.
So despite those losses for about 6 years now, you are here for the long haul. You're still expanding. Tell me a little bit more about the pace of your expansion now.
No, at this moment, our model is actually light assets approach, and we also know that there are actually more than 300 retail space that will open up this year. So with that, some are actually developers who may not want to operate these malls themselves. So these are opportunities for us too, to look for good expansion location for us, and at the same time to serve the people.
Okay, so I understand you run these department stores, but you also run malls where you bring in brands and you manage the entire malls. And in the past, you have partnered with the luxury brands like Chanel, Lancome, Prada, and so on. But we have seen this drop in luxury spending in China. Are you pivoting your strategy in any way to attract customers to keep coming to spend?
See, we have been in China for more than 30 years. And, our customers has been with us. And at the same time, we have always been finding out what are their interests and what exactly they want. And if the luxury brands is what they want and what kind of price points they are comfortable to have that, to buy that, we will always feed back to the brands. Because I think at the end of the day is whether the customer are happy coming to your store is what you can give the customers.
So did you have to advise your clients to lower the price points for customers?
We don't advise our client to lower price points because every brand has their brand strategy. But I guess at the same time we are all are always in communication. Yes.
Okay, and you've been here for 30 over years. If you look at the entire department store sector, it's not been doing that well, especially for foreign-owned stores. You look at Isetan, they have been closing down stores. Others have been pulling out of China. In Time department store was offloaded by Alibaba at a 30% discount. What are you doing differently from your competitors to stay alive for so long?
For us, I guess we are very down to earth and a traditional retailer. But at the same time, we are very customer focused. We are very focused to what our customers needs, what our customer wants, and in recent times we actually notice a different, the different spending habits, of our customers, and our customers now want more experience. Not just buying things, so we are actually putting more offerings and making it a lifestyle stores for them.
What is the price point that is more attractive for customers now, and what are they looking for when they go to your malls and your department stores?
Okay, we have actually 43 stores in 28 cities. So having said that, China is a huge country, so from north to the south, so their spending habits and the style and the things that they want are actually very different, and also due to the climate.
And how has that changed?
I guess basically, you mean how has that changed?
When you say the spending habits is different?
Oh yes, okay. In earlier days, maybe it is just picking up on physical products. But now I think after COVID, I think there is a little bit more social gatherings. So we will increase our F&B offerings.
Okay, thank you very much. That was the Executive Director of Parkson Retail, Juliana Cheng. Back to you, Haz.
Min, thank you so much for that. Bloomberg's China correspondent Min Lo in Beijing. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back, and here's a look at how Chinese tech shares are doing today, including online travel portal Trip.com. Of course, we've seen a stellar performance by Chinese tech, in particular on the back of DeepSeek and the promise of China AI. HS Tech, in particular, gangbusters, up about 35% year to date. And of course, that's coming on the back of underperformance when it comes to the Mag 7. According to some, China's tech's outperformance to Mag 7 is seen as far from over. In fact, if you take a look at SocGen, what it's saying is that Chinese tech stocks valuation remains manageable, trading 18 times forward earnings, and that's a discount of more than 40% to their U.S. peers. So a long way to go as far as they're concerned when it comes to the rally that we're seeing in Chinese tech stocks. Well, speaking of Trip.com, spurring reluctant Chinese consumers to spend has been elevated to the top of Beijing's to-do list this year. The government is planning to boost consumption and stimulate domestic demand, as it set a 5% growth target for 2025. Joining us exclusively is Jane Sun, CEO of Trip.com Group, China's biggest travel management platform. Jane, always good to have you with us. What do you make of what you're hearing from the NPC and the plans for stimulus so far?
We're very excited for the government's stimulus package. I think travel is something that brings happiness to the people, and also globally, it contributes to 10% of the global GDP, and also provide about 11% of the job opportunities. So we'll work very hard with our partners and our customers to make sure travel becomes an important pillar for the economy.
How big a boost do you think it will give to the travel industry? How big a boost would it give to your numbers?
I think the infrastructure that's built has been very well. The new airports, the road, the high-speed railway enable us to bring customers not only to the major cities, but also to the second-tier cities and long-tail cities. So we're very positive to boost the travel industry and provide high quality of the services to our customers.
Jane, give us some anecdotal evidence in terms of the travel industry domestically. What are you seeing in terms of your own numbers? What is that suggesting?
Yeah, what we have seen is the GDP growth rate normally is at the range of 4 to 5%, and travel can outpace the GDP growth rate by a couple of percentage, say 6 to 8%. And if we grow faster than the average travel industry, so we will be able to deliver a solid number.
Of course, you don't want the Chinese to be traveling just domestically, but internationally as well, because that affects the overall numbers for you. I'm just wondering, is there any concern that perhaps the policies implemented by the Chinese government will boost only domestic travel?
Not really. I think as long as people have the interest to travel, we were taught by Confucius' teaching that it is better to travel 10,000 miles than to read 10,000 books. So people are very adventurous. So for this past Chinese New Year, the top 3 travel destinations were Australia, New Zealand, and South Africa, which surprised me also because it's so far away.
What's actually providing the impetus for the shift in traveler behavior?
Yeah, so we observe different age group, and we call it 3 E's. The first E is event plus travel. These are the people who are young and do not have children. So they're very interested in going to Taylor Swift shows, Olympic Games, F1 races, plus travel. So we provide excellent packages, enable our customers to enjoy their interests. The second group are the young families with children. We call it education plus travel. These families would like to use travel as the means to educate their children for the cultures, languages, and also history. So we team up with our local operators to make sure we have museums, we have cultural tours tailored for young families. The last E is elderly friendly. People are retiring at the age of 50 to 60 years old. They're still very energetic. They're eager to travel. And this group is not time sensitive. So we're able to bring this group to the travel destinations during the slow season. And our hotel partners and destination partners really enjoy having the new youth, the elderly friendly group.
Right. Jane, are they spending as much as before? What are your numbers indicating?
Yeah, the travel group we have been bring to different regions spend quite a lot of money. So the buying power from Trip.com has been holding very strong.
Can you quantify that? How much more are they spending compared to pre-pandemic, for instance?
For overseas travelers, the spending is up by about 5 to 10%. We're also working very hard to attract the customers from the rest of the world into China, into Asia. And these customers have found great value because the price here is very reasonable. So lots of people told us, well, it's very safe, very clean, price is very reasonable, and they have a good time.
Are travel patterns being dictated as well by the movements in the currency space?
Yes, they do. This year, lots of countries have weaker currency. For example, Japan becomes a very popular travel destination for the whole world. China also offers great value to the world. So we're working very hard to make sure global customers is aware the value and beautiful destinations for China. We offer free visa for more than 40 countries. And for the countries who do not have free visa, we offer in-transit visa, which is extended from 3 days to 10 days, which make the travel is much easier than before.
Japan is indeed a popular destination, not just for the Chinese, but for everybody else. I personally have been there several times now. I'm just wondering, are there challenges on the ground with the surge in the number of travelers?
Sure. When people try to come at the same time, they'll be very crowded in the major cities. So our goal is really to a very good promotion for long-tail destinations because there are so many other places we can see. And also for the people who do not have to travel during the peak season, such as holiday seasons, we encourage them to go there during the slow season. Therefore, the destinations is less crowded and the price is more reasonable.
Jane, of course, India's in the headlines for us just about every other day. We know that India-China direct flights will resume after 5 years. Do you think that could perhaps boost travel between the two countries?
Yes, anything that is increasing the direct flights will boost the travel. So when we survey our customers, the top 3 items are safety and also direct flights and easiness for applying visas.
So how much of a boost do you think that may give to your numbers?
If the flights increase 5 to 10%, proportionally, we'll be able to see a lift by at least that amount.
Jane, we've also been talking a lot about AI. In terms of the travel sector, how do you think you'll be investing in AI to capitalize on its potential?
We mainly use AI for 4 areas. The first one is user interface becomes much more friendly. The second one is while engineers are using AI, they can cut the coding time anywhere between 15 to 30%. The third one is customer service level will be enhanced. And lastly, when we use AI, the creation of content, such as videos and pictures, are much easier and much more efficient.
Is AI influencing the way you hire or how many you hire? Is it impacting how you look at your workforce?
Yeah, we are holding the workforce at a steady level. I think the easy and the standard procedures can be handled by AI. However, during trip, there is a lot of unexpected events which need human support. For example, there was a tsunami in Japan, earthquake in Nepal, Las Vegas shootings. During this time, human employees need to support our customers during crisis moment.
So in terms of expansion, what can be anticipated in the next 12 to 24 months?
We follow our customers' route. So normally customers look at the places which offer a very friendly environment. People are friendly to travelers, where they can have direct flights, and it's easy to obtain visas. So those are the regions with great growth. For example, Singapore, Malaysia, Thailand offer free visa, and Middle East offer free visa. We saw an increase in that. And also, while China offers free visa to foreign visitors, we saw three-digit growth from the rest of the world into China.
Jane, thank you so much for your time. Jane Sun, CEO of Trip.com Group. Now, we've been talking about Japan. Let's turn to Japan. Its service sector businesses are funneling money into a rapidly growing market for robots that can work alongside people instead of just replacing them. We'll look at why the so-called service robots are seen as less of a threat to payroll numbers.
Firms across Japan are increasingly turning to technology to offset a chronic labor crunch. Its service robot market is now expected to triple by 2030. Bloomberg's Momoka Yokoyama is at a restaurant in Tokyo operated by Skylark. The company has automated a bulk of customer interactions across its restaurant chains.
I just ordered some food using this device.
Skylark has rolled out 3,000 of these cat-like robots across more than 2,000 restaurants in Japan. More and more of Japan's service sector is relying on robots to not only fill labor shortages, but help older workers and foreign hires do their jobs better.
Because of this robot, I think I'll be able to continue working for a while longer. My job is no trouble at all when I'm working with robots.
Skylark now has more than 4,000 older staff, almost double the number from 2020.
The service robot market is just getting started. Labor shortage isn't just a Japan problem, it's a global problem.
Robots are already in use across a wide range of industries, from hospitality to the medical sector, but experts say there's plenty of space to grow. And they're also appearing more often where the elderly are not just the workers, but the customers. Bloomberg's Erika Yokoyama got a hands-on demonstration of some of the robots at an elderly care home operated by Zenkokai. More than 300 devices have been tested over the past 15 years, ranging from mobility aids to communication tools for caregivers.
It's machines like this that are increasingly indispensable in the elderly care homes in Japan as the industry faces severe labor shortages in the country.
For Japan, robots helping humans is key. By 2060, 40% of its population is expected to be over the age of 65. It'll be crucial that the country looks to robots that will work alongside its workers, not replace them.
So perhaps we can coexist. Well, before we go, here's a look at our guests for next week. We'll have exclusive interviews with PepsiCo CEO Ann Se and BOC Aviation CEO Stephen Townend. Yadeni Research President Ed Yadani will also be joining us to discuss the impact of Trump's tariffs on the markets as well as the economy. We have a full lineup. You do not want to miss those interviews. That is it for Insight. Horizons Middle East and Africa is next. Do keep it here with us. This is Bloomberg.